here's what you're going to do. You're going to sell that gold with the snap of a fingers. He just tells the Treasury Department to tell the Fed chair, this is what gold is. And it's an accounting gimmick. Who in God's green earth has stood for delivery for $13 billion in gold in the month of June, and it's not over yet? Who? And why doesn't anyone say it? COMEX, guys like Ed Steer will tell you the majority of the silver that is supposedly available, JP Morgan has earmarked for other things. And they do back the long end of the bond market, which the Fed can't control, to gold. You have zero upfront borrowing costs. You owe the gold down the road. And by the time the bonds mature, gold is massively higher without even having to revalue it by the Federal Reserve. I don't know that gold will be, I'm not in the camp that says they're going to revalue gold on July 4th. I think gold will go much higher. I think they should market to market. James Rickards, who is a lot smarter than me, he's been saying gold could go and be revalued as high as $24,000. Right. We don't ever buy for ourselves, it's always for customers. Mm-hmm. The CME group in their documents will tell you they work with central banks. Who is the customer that JP Morgan was doing this for?
Okay, so I've asked you this question in the past, I'm going to ask it you again. And I don't know how much true visibility you have into this, but all right, so if it's about delivery, and that all makes sense to me, then do we have a measure of where inventory is in the system? And are there parts of the system where we can point to and say, all right, that's getting dangerously low, that if this volume continues for much longer, you're going to start having failures of delivery because they just don't have product?
Well, those kinds of metrics coming from the exchanges who you really can't even trust. David Jensen, as an example, will tell you that the free float on the LBMA is like 140 million ounces, but he questions if that free float is really even a free float. He would say that maybe it's only more like 40 million ounces, as about 100 of the 140 is owned by the ETFs kinds of thing. You look at the COMEX, and there's 300-400 contracts for every ounce out there, but they issue contracts these days. There's a bunch that are issued with, they won't let you stand for delivery and these kinds of things. And let me put it to you this way. The numbers are far worse than we would really be led to believe. As an example, on COMEX, guys like Ed Steer will tell you the majority of the silver that is supposedly available, JP Morgan has earmarked for other things. I don't know the exact numbers, and I should try and find those exact numbers, but I will simply tell you that if everyone stood for delivery, only a very, very, very small portion of those that tried to stand for delivery would receive the metal. And
right, just like a bank. Just like a savings and loan.
The most dangerous shortage is the one hidden behind inventory reports everyone assumes are accurate. Andy Schectman notes that estimates of available silver may be dramatically overstated, with some analysts questioning whether much of the reported float is actually accessible at all. If hundreds of paper claims exist for each ounce, the real story isn't supply, it's ownership rights. For wealth preservers, that distinction matters far more than daily price action. Next, Andy Schectman exposes why record physical deliveries create pressure that official inventory figures may never fully reveal.
But if you are part of the group that is standing for delivery, you have to understand this. So you have to and this is what people have a hard time understanding. Why not just stand for delivery for everything? Because just like that, the exchange would force majeure and blow up. So instead, it's death by 1,000 paper cuts. And this is why for 18 straight months, we've seen billions and billions and billions and billions and billions and billions delivered. Who in God's green earth has stood for delivery for $13 billion in gold in the month of June, and it's not over yet? Who? And why doesn't anyone say, who did that? But this is every month. $13 billion someone's spent on gold delivery when no one ever did that.
Can I ask you a question on that? Sorry to interrupt. Who would answer that question? Who could answer that question? And I guess that's COMEX. And I'd want to say, well, then does COMEX publish a list of clients? Probably not, or else you would know that
You
answer.
can figure some of it out by using the loadout numbers or the who posts the numbers for. You don't know who did it because it could be.
But let me ask you this question so you can include it in your answer. Is it protected by bank privacy laws like a client attorney privilege, Or is it something that could be gotten through like a FOIA request?
No, you can't get that information, but they do publish something called the Commitment of Traders Reports, which shows the positioning of the largest traders. And you can see, like, if JP Morgan, what's called stopped or delivered X amount of contracts, and the other bank was the one that was buying them, or one was selling, one was...
Markets obsess over price charts while ignoring the identities behind billions in physical gold deliveries. According to Andy Schectman, over $13 billion in gold stood for delivery during a single month, yet the buyers remain largely invisible to the public. That creates a contradiction. Exchanges promote transparency, while the most consequential transactions stay obscured. Investors should ask why institutional demand is accelerating quietly while headlines focus elsewhere. Next, Andy Schectman unravels how trader positioning reports reveal activity that public market narratives conveniently ignore.
You can figure it out by looking, but you still don't know who the customer was, as an example. Like when Blythe Masters, who ran JP Morgan, was running their metals desk, she said, "We don't ever buy for ourselves, it's always for customers." The CME group in their documents will tell you they work with central banks. Who is the customer that JP Morgan was doing this for? We don't know. You could figure out it might be JP Morgan, but you won't know who they're doing it for, I guess, is the issue.
Okay. All right, Andy, we're getting to the lightning round part here, just because I still have a bunch of questions and we don't have a ton of time left.
Can I just say one thing before we start?
Of course you can.
You know, one of the things that that I saw that I don't know if I've discussed with you that I find to be really interesting is, you know, we've talked a lot about the Judy Shelton thing, right? And even if it doesn't happen July 4th, I still think it's a valid point. But there's something that I don't know if you noticed that happened that, again, just makes you go,
I think this is one of my questions I'm going to ask you, but go ahead with it.
Paul
Are you talking about the
Winfrey?
U.S. Mint?
No, we can talk about the U.S. Mint also. How about Paul Winfrey? Do you know who Paul Winfrey is? He is Kevin Warsh's first policy advisor, and he'll be his top policy advisor. And he's the new top key policy advisor to the Fed. He used to work in the previous Trump White House as the deputy assistant for domestic policy.
The names moving behind the scenes often matter more than the headlines dominating financial television. What Andy Schectman is highlighting is that institutional transactions frequently occur through intermediaries, making the ultimate buyer nearly impossible to identify. When central banks, bullion banks, and exchanges intersect, transparency becomes selective rather than complete. For investors, the unanswered question isn't who executed the trade, it's who needed the metal badly enough to stay hidden. Next, Andy Schectman reveals why an overlooked Federal Reserve advisor may signal a major shift in gold policy thinking.
He's a Heritage Foundation scholar, blah, blah, blah. But he was one of the 20 or 30 economists that took a chapter in Project 2025. It's a report that was all about mandate for leadership, whatever the hell that means. But his chapter, chapter 24, was on the Federal Reserve. And guess what his chapter talked about? He seriously explores returning to or running a parallel gold standard to fight inflation and the boom and bust cycles that the Fed creates. He highlights, of all things, gold convertible treasury instruments, aka gold bonds, as a practical transitional tool. Judy Shelton's idea.
Yeah. I feel like we should call those bonds Sheltons.
Yeah, we should call them Sheltons, 100%. But I find it really interesting that the first person that he hires is a guy that has written about, in a report that we're all top economists, on convertible gold bonds. It's just another thing like the gold coins that are being issued. I don't know that gold will be, I'm not in the camp that says they're going to revalue gold on July 4th. I think gold will go much higher. I think they should market to market. But there are guys out there like James Rickards, who is a lot smarter than me, who, you know, he's been saying gold could go and be revalued as high as $24,000.
Right. We've seen all those different math exercises, yeah. Okay, so, sorry, there's just tons and tons of questions getting asked here. Real quick, I just wanted to note for your interest, but also for the whole audience's too. So you're talking about Judy Shelton. Andy, I'm going to be doing a panel next month, or sorry, in early August with Judy, Lacey Hunt, and Tom Honig. So got these three greats, all of whom have worked at the Federal Reserve or been considered for positions there.
Policy shifts rarely begin with announcements. They begin with personnel changes most investors never notice. Andy Schectman's argument suggests that discussions around goal-backed instruments are migrating from fringe debates into circles closer to policy influence. The timing matters because ideas dismissed during stable periods often return when debt burdens become harder to manage. Savers should watch appointments and advisory roles as closely as economic reports. Next, Andy Schectman exposes why gold bond proposals keep resurfacing whenever monetary credibility starts coming into question.
In Tom Honig's case, sat in the FOMC. So if you're curious about all things Fed, we're going to have just a all-star panel for that, and that's going to be in early August, folks. And I'll give you greater updates on it as we get closer. Still got a couple other rapid-fire questions for you here, but in the spirit of what this guy asks, okay, enough talking. Let's get to predictions. I'm not going to force you to make a price call here, Andy, but my question to you, to the spirit of the title of this this video, is, where's the bottom, right? And nobody really knows. But let me ask you this: what are prices at which you would say, I didn't think it was going to get that low? This just seems crazy.
I think we're pretty close to there right now. I think you would have shook out all of the speculation at under $60 in silver and all of the hopium at the same time. I think breaking 4,000 in gold is the same thing. We're right there. All of the futures contracts, all of the options, they'll all expire worthless. I would say we're right at that number right now. I'd be surprised to see it have that much more weakness, but who knows? I didn't think it would go this far to begin with.
I think you're getting a really good chance to buy the precious metals at a pretty darn good value at this point in time.
The best buying opportunities rarely feel comfortable while they're happening. This is where Andy Schectman's thesis shifts from market structure to investor psychology. Major corrections often erase speculative positioning, force options to expire worthless, and convince retail investors the trend has ended. Yet those same conditions frequently attract long-term capital-seeking value rather than momentum. The risk for savers is not volatility itself, but abandoning a strategy near exhaustion points. Next, Andy Schectman reveals why emotional capitulation often arrives just before institutional accumulation becomes visible.
Well, it's just, cost averaging for sure. And the reason that maybe it doesn't resonate as much with me when prices are that high is that and I've always been clear, I tell people gold is wealth. You don't buy it to become wealthy. You own it because it is wealth. And so it's one of these things that you shouldn't be focusing on every single day. And, the volatility is what has kept people out, yet it continues to march higher every single year. So volatile, people don't even notice it's marching higher and outperforming traditional assets. You focus too much on it, you're hoping to get wealthy, you're owning it for the wrong reasons, and it's going to tug on your emotions. So yeah, I own it because I know in the end, it's going to be much higher based upon a system that there is no way that the dollar can come back to a semblance of strength when we're 200 trillion in debt, when interest rates have nowhere to go but higher, when our populace is largely uneducated, 60% of the country with the literacy rate under the 6th grade, where indebtedness goes far beyond what is indebted by the government. The people are massively in debt. Savings is at all-time lows. These are things that are inescapable, in my opinion, and ultimately pushes inflation higher, pushes the dollar lower, pushes gold higher, ultimately. And the big money repositioning, standing for delivery, using weakness to do so, betrays everything that you're feeling. It does. And it's hard to pull back, the emotions, say, yeah, that's true. I sympathize. I get it.
Most investors watch gold prices daily while institutions focus on preserving purchasing power across decades. Andy Schectman notes that volatility distracts attention from a longer trend driven by debt expansion, declining savings, and persistent monetary pressures. The contradiction is that assets viewed as unstable often outperform during periods of structural instability. For retirement-focused investors, protecting wealth may require ignoring short-term noise that dominates financial media coverage. Next, Andy Schectman exposes why institutional buyers often increase physical purchases, precisely when public confidence weakens.
I feel the same things. I mean, I've done this for 36 years. You can only imagine the multitude of emotions that I've dealt with. And my son works for me. I have to deal with his texts every morning. He texts me this morning. First thing my son says to me this morning, he says, still don't understand how silver can be this manipulated. Well, I mean, it's true.
Dad, make it up.
Until it's not. And the deliveries are making it ultimately not. Not yet, but when all of the big money is saying we'll take physical bars, when the countries like France and Germany and the Dutch and the Czech National Bank, Poland, Hungary, Turkey, Austria, they all say, give us back our gold. India, give us back our gold from the Bank of England and the New York Fed. It tells you where this is ultimately going. You know, and I keep saying to people, it's the deliveries that will break it. Think about this for a moment. What caused Nixon to close the gold window? What broke the facade? Do you remember?
I think it was countries like France saying, yeah, we're taking it back.
De Gaulle saying, I want delivery, pulled up warships to New York Harbor with dollar bills, and he had the right to do so. Give me the gold. What broke Bernie Madoff? Delivery. What's going to break this? Delivery. And price is a tool of misdirection by those that are grasping at anything they can, either to cover, to stand for delivery, or to mitigate their what is an existential threat. Easy for me to say, not easy to hear, but I do believe it in my soul.
Markets can suppress price signals for years, but they cannot manufacture physical metal indefinitely. According to Andy Schectman, the critical trend isn't silver's quoted price, but the growing preference for actual delivery among institutions and sovereign entities. History repeatedly shows that confidence-based systems fail when participants demand settlement rather than promises. Investors should pay attention when nations repatriate gold, because actions often reveal priorities more honestly than public statements. Next, Andy Schectman unravels why physical delivery has exposed weaknesses in monetary systems before and may do so again.
Remember, Triffin's dilemma says that other countries will sell their currency in the open market to buy dollars, just like Brent is talking about,
Right.
to buy oil and to transact business. They need to, so the dollar goes higher relative to other currencies that are being sold to buy the dollar. Not a good measuring stick. Measure it against gold, the one neutral barometer by which everything is measured. So, yeah, I mean,
the point I'm trying to make here is there's your argument which is that, look, all these other countries are trying to break free of the shackles of the dollar, so they're buying gold to build that new system. And what I'm saying is in the U.S., in its next generation, may be creating additional demand for gold as well through stablecoins. So even though you've got this big competition going on, who's the beneficiary? Well, in the long run, it should be gold.
Well, that's my entire thesis that I've talked about publicly is this is a big part of it. You use the movement of money, which anytime money moves from next January on, it's on stablecoins, on a blockchain, and the interest isn't transferable. So by taking that interest and buying gold, you devalue the dollar, make the debt easier to pay off, and also make manufacturing easier to sell. How do you bring back manufacturing? Well, this brings us to the Judy Shelton theory again. And if she's right, and they do back the long end of the bond market, which the Fed can't control, to gold, you have zero upfront borrowing costs. You owe the gold down the road. And by the time the gold or the bonds mature, gold is massively higher without even having to revalue it by the Federal Reserve.
A stronger dollar can mask weakness if the measuring stick itself is flawed. What Andy Schectman is highlighting is a scenario where both competing monetary blocks end up creating demand for gold simultaneously. While investors debate currencies, institutions may be positioning around the asset sitting beneath the entire system. If future financial infrastructure channels capital toward gold indirectly, today's assumptions about demand could prove outdated. Next, Andy Schectman reveals the hidden connection between stablecoin expansion and long-term precious metals demand.
Which they could do, or by the government with the snap of the fingers. He just tells the Treasury Department to tell the Fed chair, this is what gold is. And it's an accounting gimmick. Maybe marking it to market is something they should do right away, but letting gold move up, which would in essence be organically yet synthetically, because this entire demand for the front end of the curve through the Genius Act is synthetic, and transferring that interest into gold benefit. And the one part that I think there is a line of is a conspiracy or a reality is, Bo Hines is in there now. Was there a wink, wink, nod, nod to Tether? Listen, you guys are no longer going to be investigated. Here's what you're going to do. You're going to sell that gold that you continue to buy with the interest to the U.S. Treasury quietly. So now you have a proxy bank or a proxy institution, a fintech company running proxy for the U.S. government to keep their name out of the open gold market, buying gold on behalf of the U.S. government. They have bought more gold for 3 years in a row than anyone in the world, with the exception of the Bank of Poland. So could it be? Sure, why not? I think misdirection, everything is not just right in front of your face.
Okay. I want to pull up another user comment here. Again, this is more just venting, but I'm bringing it up.
I'm all
for
right
reason.
with the people have the right to vent. I get it.
The most important market shifts often appear first as improbable theories before becoming accepted policy. Andy Schectman's argument suggests that future gold accumulation may occur through indirect channels rather than obvious central bank purchases. Whether or not specific scenarios unfold, the broader pattern is worth watching. Governments frequently use intermediaries when strategic objectives require discretion. Investors who focus only on official disclosures may miss where capital is actually moving,